Meeting the world's climate targets will require the scaling of existing clean technologies, as well as the rapid deployment of newer, early-of-a-kind or first-of-a-kind solutions. These include a broad range of technologies, from new types of sustainable aviation and shipping fuels to carbon dioxide removal, green steel, green cement, battery, and nuclear technologies. And yet financing these first-of-a-kind projects is hard. This COP is all about implementation, and fundamental to implementation is securing finance. So today I'll outline what it takes to attract investment into first-of-a-kind solutions, and how to structure transactions that both deliver the financial returns that investors seek and advance the transitions that governments are aiming for. At the GFI, we've mapped the key stages in moving from government ambition to investable markets. This isn't a linear process, and crucially, each stage along this pathway needs to be co-designed with financing in mind, ensuring projects are attractive to investment. We call this aligning transactions and transitions. Let's look at a practical example we're working on. Scaling up the use of sustainable aviation fuel, or SAF, is a solution essential for decarbonising air travel while supporting jobs, prosperity, and energy security. Governments around the world have passed mandates requiring airlines to have a certain percentage of their fuel be sustainable by 2030. These are essential in creating a demand signal, but insufficient to attract finance. Scaling SAF means building new plants, which require billions in capital. Investors won't commit unless they see dependable cash flows. That means long-term offtake agreements need to be in place with robust parties, and these offtakers want the producer to have credible supply agreements and technologies that are proven to work at scale. Each part of that value chain, from feedstock to fuel buyer, must be contractually aligned in order to secure financing. If this looks complex, it's because it is. But the challenge is not insurmountable if we ensure finance-oriented policy is backed up with a logical work programme that involves both public and private stakeholders. Let's break this down further into the key areas of risk that a financier will need to see addressed. 1. Performance. 2. Feedstock. 3. Price. Firstly, who takes on the risk that these new technologies will perform? The technology and delivery providers may struggle to provide guarantees and warranties at a price that makes the project feasible. This is where public and private sectors need to play their respective roles in taking on risk. Public grants for development expenditure and front-end engineering design funding are critical for product innovation. Public institutions like development banks and export credit agencies can provide guarantees, structured finance solutions, and cornerstone funding that can allow commercial lenders to provide funding at acceptable terms. Private sector tools like performance insurance and strategic equity provided by corporates, such as airlines, can also help spread the risk. Used together, these instruments and approaches help build confidence and unlock initial investment. Next, we need to ensure the key ingredients, the feedstock, to make SAF are in sufficient supply and at a relatively stable price. Some advanced SAF solutions rely on inputs like green hydrogen and captured carbon, which are themselves emerging industries, which can create project-on-project risk, where one project's success depends on another's. To manage this at the policy level, we need joined-up planning across sectors. Commercial structures like tolling arrangements that pass input costs through to buyers can also help ensure the cash flows of future plants. Perhaps most importantly, bankers and investors need price certainty on SAF. Supporting their mandates, governments can provide price certainty mechanisms, which can take the form of a guaranteed price, ideally over a longer time frame. This gives lenders confidence their debt will be repaid, and it helps producers plan for the long term. Other tools like public procurement and collective offtake agreements can also support market development, especially in the early years. Whilst the whole picture can appear overwhelming, when we break it down to key public and private interventions to address each risk and project manage the collaboration needed, we are reaching the stage where the first few SAF plants are moving to final investment decision. We have a long way to go, but through applying the discipline to create fundable transactions, we can also ensure the correct granular policies are put in place so that those transactions can scale and lead to the transitions that governments seek and that the climate science dictates we all need to deliver.